let's talk about something that might sound boring at first, but is secretly one of the most important concepts in business and investing: depreciation. Picture this: you're running Big Tech Inc., and you just bought a shiny new server for $100,000. It's a big investment. But here's the catch: this server won't last forever. Over time, it'll wear out, become outdated, and eventually need to be replaced. Instead of recording the full $100,000 as an expense in the year you buy it, you spread that cost out over the server's useful life. Let's say 5 years. That means you'll record $20,000 as an expense each year. This process is called depreciation, and it's a fundamental part of how companies manage their finances. Depreciation helps companies match the cost of their assets with the revenue those assets help generate, year after year. It's about aligning expenses with the income they help produce, giving a more accurate picture of profitability. Here's something crucial: depreciation is a non-cash expense. That means no money actually leaves the company's bank account when it's recorded. It's simply an accounting entry, but it can have a big impact on reported profits. The key phrase here is useful life. Who gets to decide how long an asset will last? The company does, based on their own estimates and judgment. They estimate how long their servers, buildings, and equipment will keep working. And what's considered reasonable can be surprisingly flexible, especially when billions of dollars in profits are on the line. This is where things get interesting. Some companies are quietly stretching the definition of useful life to make their profits look better on paper, even if the reality is different. Why does this matter? Because depreciation isn't just a sleepy accounting rule. It's a powerful lever that can make a company's profits appear much stronger than they actually are. As we head into 2026, this quiet accounting game is getting riskier. Regulators and investors are paying closer attention, and the stakes are higher than ever. Depreciation isn't just about numbers on a spreadsheet. It's about how companies craft and communicate their financial story to the world, shaping perceptions and influencing decisions. And right now, some of the world's biggest and most influential companies are getting very creative with that story, using depreciation as a tool to manage their image and their bottom line. So, let's pull back the curtain and see how this accounting trick is being played at the highest levels of business and finance, because the way companies handle depreciation could impact your investments, your retirement savings, and even the stability of the entire market. Imagine this: a tech giant quietly decides that its servers will now last 6 years instead of just 4. It sounds like a small change, but the implications are massive. Overnight, annual depreciation expenses drop, and reported profits surge, without the company actually selling more products or improving its core business operations. All it takes is a simple tweak in a spreadsheet, and suddenly the company appears far more profitable to investors and analysts. This isn't just a hypothetical scenario. Some of the world's biggest tech companies are doing exactly this right now. Since 2020, as they've poured billions into building new data centers and developing advanced AI, they've quietly extended the useful lives of their equipment, changing the math behind the scenes. These companies claim it's all thanks to better engineering and more durable hardware, but the timing is suspiciously perfect for boosting earnings per share and impressing Wall Street. It's a subtle accounting maneuver, often buried deep in lengthy financial reports, but the impact on reported profits is enormous and hard to ignore. While this practice is perfectly legal, it creates a growing gap between the profits companies report and the true economic reality of their businesses. The result? Investors see stronger financial numbers and rising stock prices, but the underlying business fundamentals haven't actually improved at all. That growing gap could spell serious trouble for investors and the market down the road, as reality eventually catches up with the numbers. Who's playing this game? The biggest names in tech, Alphabet, Microsoft, Amazon, Meta, all have stretched out their depreciation timelines. By doing so, they've made their profit margins look healthier, even as they spend billions on infrastructure. IBM's depreciation expense dropped sharply while its revenues grew. thanks to accounting, not business growth. Oracle's been flagged for similar moves, and Nvidia, the AI chip king, is now under the microscope for its own depreciation assumptions. These aren't small players, they're the backbone of the market. Their accounting choices ripple through the entire financial system. The question, are these profits real or just the result of creative math? Let's dig into why some experts are sounding the alarm. Michael Burry, the investor who predicted the 2008 crash, is now warning about this very issue, especially at Nvidia and Oracle. Burry argues Nvidia's depreciation schedule is far too optimistic for a company in a fast-moving industry. Their chips lose value quickly, but the company is slow to write off those costs. That inflates reported profits, making the business look stronger than it is. If Burry's right, Nvidia's sky-high valuation is built on shaky ground. The risk? If investors realize these profits are more accounting illusion than reality, the stock could tumble. It's a warning worth taking seriously. Creative accounting brings back memories of epic corporate disasters. Enron, WorldCom, Adelphia. Those scandals were outright fraud, but today's tech giants are operating within the rules. Still, the effect is similar. A widening gap between reported profits and true business health. The early 2000s scandals led to major reforms, but the impulse to manage earnings hasn't gone away. Today it's legal, but it still distorts reality. The risk isn't fraud, it's that investors are being misled by numbers that look better than they should. When companies prioritize appearances over accuracy, trust erodes, and when trust goes, markets can unravel fast. The lesson from history? Don't ignore the warning signs, even if the methods are more subtle, because the consequences can be just as severe. If these accounting changes don't create real value, why bother? It's all about perception. Investors watch the price-to-earnings (PE) ratio closely. High PE means high expectations and high risk. By boosting reported earnings through slower depreciation, companies make their PE ratios look more reasonable. It's a cosmetic fix, not a business improvement. The goal: keep stock prices high and investors calm. CEO pay is often tied to stock performance, so there's extra incentive to keep the numbers looking good. It's about managing the narrative of unstoppable growth, even if the reality is less impressive. In the end, it's a numbers game designed to keep Wall Street happy, but it doesn't change the fundamentals. Here's the key. Changing depreciation schedules doesn't create cash. It's an accounting illusion. Profits go up on paper, but the company's bank account stays the same. Real value comes from cash flow, not clever bookkeeping. When companies extend asset lives, reported profits rise. But nothing changes in their ability to generate money. Investors who focus only on headline earnings can be misled. If profit growth is just an accounting trick, it's what analysts call low-quality earnings. Over time, cash, not reported earnings, determines a company's true value. Cash pays for innovation, acquisitions, and dividends. Reported profits are just an opinion. Cash is a fact. And right now, the facts may not be as rosy as the numbers suggest. So what's the risk? If everyone's doing it, who gets hurt? The answer, potentially, everyone. When risky behavior becomes the norm, the consequences can ripple far beyond just a few unlucky investors. The entire financial system can be put in jeopardy. The market runs on trust. If investors lose faith in reported profits, panic can spread fast. Confidence is the invisible glue holding the system together, and once it cracks, fear can take over in an instant. Imagine a major bank reveals Nvidia's real PE is much higher than reported. Suddenly, what seemed like a solid investment starts to look risky, and questions arise about what else might be hidden. That could trigger a sell-off. Investors might rush to exit, trying to protect themselves before prices fall even further, creating a self-fulfilling spiral. When tech giants stumble, the whole market feels it. They're a huge part of major indices. Their influence is so great that a shock to one can shake the entire financial landscape. A crisis of confidence could hammer retirement accounts and pension funds everywhere. Millions of people who depend on these savings for their future could see their plans upended in a matter of days. The foundation of the market is fair, accurate numbers. If that's in doubt, the whole system is at risk. Transparency and honesty are what keep the gears turning smoothly. This isn't about rooting for failure. It's about recognizing the danger of building on shaky ground. Ignoring warning signs only makes the eventual reckoning more severe. When reality and reporting drift too far apart, the correction can be brutal. The longer the gap grows, the harsher the snapback to reality will be. And the fallout won't just hit Wall Street, it'll hit Main Street too. Everyday people, small businesses and families could all feel the pain, reminding us that financial risks are never contained to just one corner of the market. This isn't just accounting jargon, it's about honesty and trust. Are the world's biggest companies giving us a true picture or just a polished performance? As we head into 2026, investors need to look deeper, beyond headline numbers, into cash flow and footnotes. Ask, is profit growth real, or just a result of creative accounting? Understanding the difference between high and low-quality earnings is crucial for anyone in the market. Even if you don't own stocks, these companies shape our economy and society. When they fudge the numbers, it erodes trust in the whole system. This is a stress test for our financial rules and for investor savvy. History shows that when reporting and reality diverge, the snapback is ugly, so pay attention. The stakes are higher than you think.